Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. Rupinder Singh Sodhi was at the helm of India's biggest dairy brand, Amul, for the last 12 years. During his tenure as the MD of Gujarat Cooperative Milk Marketing Federation, which owns Amul, the sales grew by over 5 times. Even as another company insider, Jayant Mehta, replaces him, the nature of Sodhi's exit has raised a few questions. But Sodhi said he had asked the cooperative to relieve him of the responsibility, notwithstanding the row surrounding his exit. Sodhi leaves behind a rich legacy. Tushar Verma takes a look at that, and he also tells us about the challenges that one of the world's top milk processors faces under the new leadership.
In a farewell message on Twitter, RS Sodhi thanked farmers of Gujarat. He said that after working 40 years and 9 months with Amul, I am indebted to 36 lakhs farmers of Gujarat for giving me all the love, recognition, fame, well-being and respect. Shall continue to work for the benefit of them. This message followed the news of Sodhi's departure from Gujarat Cooperative Milk Marketing Federation or GCMMF that sells dairy products under the brand name Amul. Sodhi had joined Amul in 1982 and he took charge as its managing director in 2010. The dairy brand flourished under him. In the financial year 2011, Amul's turnover was about 9,800 crore rupees. It touched a whopping 61,000 crore rupees in FY22. Amul grew at a CAGR of 16% since 2010. In FY22, it registered a growth of 18.46% against the backdrop of post-pandemic recovery. In the last 12 years, Amul has steadily increased its milk procurement, added more farmers, and expanded to more states. Its milk procurement has increased from 90 lakh litres per day to more than 260 lakh litres per day in 2022. The cooperative commands a base of 40 lakh milk producers in India. With Sodhi as its MD, Amul added 6.5 lakh milk producers in Gujarat and 7 lakhs outside Gujarat in a decade. Apart from simply increasing milk procurement, in the last 10 years, Amul has also increased the per kg cost of fat. In 2009 to 10, the milk procurement cost was Rs 337 per kg, which grew to Rs 850 per kg fat in 2022. Just 4 weeks before he left, Sodhi talked about how Amul was also open to competition. Speaking to the morning show then, this is what he had to say.
Those who are able to have a very efficient supply chain, wherein they can give good price to the farmers, another side very good product at affordable price to the consumer, they'll be able to succeed or survive.
With Sodhi stepping down, Jayant Mehta, who is the current COO and has been with the organization for 32 years now, has now taken over as interim MD. So will this change impact operations of India's largest dairy?
Amul is not a listed company, so from that perspective, it doesn't have to mandatorily have many or make disclosures to shareholders or have mandatorily many other policies and regulations in place. But yet, being a systematically, I would say, large company, it should have adopted many of these leading corporate governance practices. So I don't think the departure of Mr. Sodhi will have an immediate or any impact on the operations of the company itself on a day-to-day basis.
Under Sodhi's leadership, Amul also launched diverse products such as frozen foods, milk and non-milk beverages, packaged foods, bakery products, and much more. Its ice cream business saw a sharp revival with more than 50% value growth in 2022. After the sudden exit of Sodhi, what challenges will the new MD face to further build the brand Amul?
I have seen the Korean era, right? So when Mr. Korean went, nobody would have believed that there would be someone who would be able to take over the reins of Amul. Fact has been that when Mr. Sodhi came in to when he's departed, I mean, sales for Amul have gone up by maybe 10 times. So I think every subsequent individual who takes over a company will leave his mark on the company. So it is not as if one person has departed and that is the end of the brand. So I'm very sure that the new incumbent will make his own mark. He will do his own, contribution to the brand and take Amul to a higher pedestal.
Sodhi's sudden exit has not gone unnoticed. Some reports claimed that he was told to leave. The letter sent by the cooperative to Sodhi was also strongly worded. Sodhi, on his part, has denied the reports, saying that he was on an extension for the last 2 years and that he had requested the board to relieve him of his duties as the MD. So, is it a sign of a disquiet within the organization?
Whenever there is a long tenure managing director, I think he or she starts believing that they are synonymous with the organization. Fact of the matter is that the organization and the individual are really two separate entities. So I think in the fact that Mr. Sodhi had a very long innings, he started to believe perhaps that he was equal to brand Amul. The fact remains that the board had the right to both appoint him and to dismiss him. Corporate head honchos coming and going is a matter of controversy for a couple of days. After that, it doesn't really matter.
And with a new managing director in place, what are the challenges for Amul in the years to come?
I mean, it obviously faces competition from, I would say, regional players or even private milk players who have come. Amul has gone into these value-added products where it faces competition from even the FMG players like ITC and Britannia and the like. So in cheese and the like. And obviously, there is the push from the New Zealand and Australia dairy lobby to come into India and allow dairy products from these countries into India. So I think Amul has to obviously weather these storms in future.
While it's normal for business leaders to jump ship, Amul as an organization is not likely to face any storm following Sodhi's departure. However, industry insiders believe many a challenge awaits the new MD. The dairy major will have to face competition from private players in the country and may have to deal with international pressures as well.
Just before his exit, Sodhi had told a national daily that a significant portion of Amul's growth is coming from Tier 2 and Tier 3 cities. With the rise of the middle class, smaller cities are now the key driving force in most companies' growth. Oyo founder Ritesh Agarwal said that Oyo witnessed higher bookings in Varanasi than Goa during the new year. The startup is trying to recover from the pandemic shock. It is cleaning up its books. It is also trying to raise money from the markets. But Oyo's IPO has been hanging fire for a while now. SEBI has now asked the firm to refile the papers. Raghav Agarwal offers a peek into Oyo's financials and also tells us why its IPO is getting delayed.
The Securities and Exchange Board of India, or SEBI, has returned the draft red herring prospectus of Oracle Stays, the parent company of hospitality chain Oyo, asking it to submit it again with some updates and revisions. The company, which plans to raise 8,430 crore rupees from the market, had filed the papers in September last year. But now, it seems the recent move will delay the Oyo's IPO by a quarter. But why is Oyo's IPO getting delayed? Why is this famous and promising hospitality chain struggling? Let us start from where it all began. In 2012, Ritesh Agarwal, who was then only 19 years old, founded Oracle Stays for budget accommodations. He had earlier dropped out of college to travel around the country. In 2013, it was renamed Oyo. Soon enough, the startup found high-profile investors like SoftBank, Sequoia India, and Lightspeed Venture Partners. It expanded across Southeast Asia, China, and the US at an impressive speed. After raising $260 million in a round led by SoftBank in 2018, Oyo for the first time revealed its plan to list on the bourses by 2022. By 2019, the startup's valuation had risen to $10 billion. It had over 17,000 employees and had set up 26 training institutes across the country to train people in the hospitality sector. But the finances of the company were, however, shaky. In 2018-19, it recorded a net loss of 2,364 crore rupees, and in the next financial year, in 2019-20, Oyo's losses rose to 13,122 crore rupees. And meanwhile, the pandemic struck. The hospitality sector was among the worst hit. Struggling with losses, the company on January 2020 announced that it would lay off 2,400 employees, which were roughly 20% of its total employees. In October 2021, Oyo filed its draft red herring prospectus with the SEBI to raise 8,430 crore or $1.1 billion. At the time, the company's valuation was $9 billion. It was expected that the listing would take place in 2022. However, due to the pandemic and later the war in Ukraine, the share market had turned highly volatile by the end of FY22. In May, Bloomberg reported that the travel tech firm was planning to shelve its IPO because it could hurt the valuation. In September 2022, the company filed updated papers with SEBI targeting the IPO by early 2023. Meanwhile, its accounts continued to show stress. In FY22, the company's loss widened to 1,940 crore rupees. In the second quarter of FY23, it reported a loss of 333 crore rupees. SoftBank too drastically slashed the internal valuation of the company from $10 to $3.4 billion. In December last year, Oyo announced that it would lay off 600 more employees, mostly in line with other tech giants like Amazon, Meta, and Alphabet. In the same month, SEBI returned its DRHP and asked it to refile it. The situation at the company was a tad better in FY23. In the first half of the year, Oyo's losses narrowed to 747 crore rupees from 801 crore compared to last year. On an yearly basis too, the company's losses narrowed to 1,940 crore rupees in FY22 from 3,945 crore rupees in FY21. According to experts, with many IPOs of new age companies not performing well, SEBI has now tightened IPO valuation scrutiny to protect retail investors from burning their fingers. They now need to get their non-financial metrics audited and explain the valuation.
Post the major crash of Paytm and questions raised on valuation metrics, SEBI had tightened IPO valuation scrutiny. The focus was basically to protect the retail investor from burning their fingers in these new age IPOs. The IPO bound companies have now to get their non-financial metrics, KPIs, that is the key performance indicators, audited and then explain how they are used to arrive at the IPO valuation.
Oyo's IPO has some other issues too. Arun Kejriwal of Kejriwal Research and Investment Services points out.
1/4 of the revenue comes from India and 3/4 of the revenue comes from overseas. Or in simple terms, for every rupee of revenue in India, the company has 3 rupees of revenue which comes from outside India. There would be questions on why does such a company need to register or list itself in India. It should go overseas, because that's where the bulk of the revenue is coming from.
Kejriwal also said that major hotel management businesses in India like Taj and Oberoi provide manpower and manage the resources of their partners. For that, they get a revenue share of 3 to 5%. Oyo, on the other hand, does not provide any such managerial services, and yet it charges a 25 to 30% share in the revenue. Analysts are worried it would diminish the valuation post-listing. The company is caught in several legal disputes too.
Secondly, if you notice what's happened in this particular issue, is there are multiple cases which have been filed against the management of Oyo in various courts, high courts, etc., all across the country, where there are disputes between revenue sharing, there are disputes of various kinds. One case was settled recently where Oyo had not allowed the listing of hotels or properties of a particular group to come onto the company. That case has been settled and Oyo had to dish out in excess of 200 crores. Now, when would these cases get resolved? Your guess is as good as mine. But with so many cases on the core business model of a company being under dispute definitely makes an investor or prospective investor very, very worried about the business that he is going to invest in.
So, what valuation can Oyo expect?
Oyo seems to have reported a minor EBITDA, a positive for Q1 FY23, but that seems to be on the back of major cut in manpower costs. As the growth on the top line, doesn't seem too impressive, looking at the way the industry has bounced back. So I believe Oyo would be looking at a valuation between about $4 to $7 billion, but may still be finding it difficult to justify.
The financials of the company, particularly EBITDA, seems to be improving, but the management of the company might need to address the issues of the investors to keep Oyo's IPO a safe bet for investors.
Meanwhile, the 16th edition of Auto Expo is creating solid buzz among industry players, but investors have refrained from betting on related stocks. Analysts, on their part, see this as the obvious reaction. First, giants like Audi, BMW, M&M, and Skoda have given it a miss. Secondly, automakers are showcasing new models of electric vehicles where four-wheelers hardly command any market share. However, given the improving infra around EVs, will these new launches at the expo shift auto stocks into top gear? Nikita Vashisht decodes in our next segment.
India's flagship motor show, Auto Expo, returned after a gap of 3 years yesterday. While the likes of Maruti Suzuki, Tata Motors, Kia India and MG Motor India will lead the traditional automakers, M&M, Skoda, Mercedes-Benz and Audi have decided to give it a miss. But contrary to the buzz on the ground, stock markets were unenthusiastic about the grand showcases. The Nifty Auto Index hovered lower with 13 of the 15 index constituents closing the day in the red. Analysts believe the expo is unlikely to boost sentiment across counters as this year's edition lacks participation from major listed players. Besides, the focus is on electric vehicles, a segment where four-wheelers have a minuscule market share.
This Auto Expo is, it has brought a complete array of new refreshes and variants and new models, etc. More on the EV side. So, the OEMs are definitely expecting that the EVs is the next in thing for them. But, according to me, there is still some time left for the EVs to spread left and right and center, in the overall automobile industry. Definitely, there is some, demand still for the ICEs, still with the picture on the EVs get cleared or clarified up to a good extent.
According to the Society of Manufacturers of Electric Vehicles, more than 8,16,000 units of EVs have been sold in India so far in the current financial year. Of these, 62% were two-wheelers and less than 4% were four-wheelers. Commercial vehicles commanded just 0.19% share. Add to it, Deepak Jasani of HDFC Securities said showcasing of new products doesn't necessarily equate to higher sales.
This is a showcase event. Basically, this shows the seriousness of the players for introducing new technology and new products. Now, whether these products will sell, to what extent, how will they be priced, that is yet to be known. But companies basically want to create some sort of impact by launching products at these show. So one should not sort of correlate if these are the products and whether they will sell, whether there is a demand for this or not. So if they have showcased 10 products, maybe 2 of them or 3 of them will be launched and 1 or 2 out of them will be successful. So I think that is the way one should look at the products which have been showcased at the Auto Expo.
Analysts believe investors may adopt a buy on dips strategy for the pack as overall sales growth is expected to remain steady going forward.
The upside and all that is left, because see, now FY23 was a very good year for most of the commercial vehicles as well as the passenger vehicles and all. But because because of the chip shortage, the passenger vehicle demand was there, but they couldn't supply or cater to whatever the demand was. So the order book is still quite strong, and the new launches are coming up. So FY24, the visibility for the volumes is quite good on the PV side. So FY24 will be a very good year on a lower base of FY23. The commercial vehicles and all, maybe there will be slight slow down in their growth rate, because now if you see in the YTD growth of Ashok Leyland and all, it's close to about 75 to 100%. So that growth will not continue in FY24. There will be some sort of slowdown, but definitely there will be a demand for commercial vehicles. Slowdown in the sense on the growth rate, but because of the high base.
Retail sales in calendar year 2022 rose 15% year-on-year at 21.12 million units as against 18.32 million units sold in CY21. As per data provided by the Federation of Automobile Dealers Associations, PV sales were up 16.35% year-on-year, while CV sales grew 13% on year. As sales outlook for the coming quarters looks strong and input cost pressures recede, analysts expect premium valuations of auto stocks to sustain. Patil of LKP Securities likes M&M and Ashok Leyland at current levels and suggests buying Maruti Suzuki shares on dips. As regards today, India and the US retail inflation data for the month of December will be keenly awaited by investors. Besides Cyient, HCL Technologies and Infosys are the prominent companies due to report their December quarter's results today.
After the markets, let's move on to a rather pressing issue: the safety of our planetary life. In good news, experts recently said that the ozone layer, which blocks the harmful UV rays, is finally filling up. Steps taken after the Montreal Protocol made it possible. In our Decoded segment, we tell more about this treaty and how it helped in the healing of this crucial layer. The ozone layer is finally healing, slowly but steadily. A panel consisting of the World Meteorological Organization, UN Environment Programme, NASA, European Commission and USDC recently said that the layer which protects us from the harmful ultraviolet rays of the sun will be fully repaired by 2066. The layer will take maximum time to repair over Antarctica, which has the deepest hole. Over the rest of the world, it will be repaired by 2040. The panel credited 1989 Montreal Protocol for this positive development. The depletion of the ozone layer was first noted by the scientists in the 1980s. The layer, which is made up of ozone or 3 particles of oxygen, was being harmed by the use of a class of industrial chemicals containing chlorine, bromine or fluorine. The most prominent of these were chlorofluorocarbons or CFCs, which were extensively used in air conditioners, paints and refrigerators. These chemicals led to thinning of the layer. This in turn increased the chances of skin cancer and other ailments due to the UV rays of the sun. The thinning was more prominent over the South Pole. Understanding the gravity of the situation, Montreal Protocol was adopted on September 16, 1987 and implemented on January 1, 1989. Under the treaty, all parties were given specific responsibilities that would lead to the phasing out of the different groups of ozone-harming chemicals. It included control of the trade of these chemicals, annual reporting of data, and national licensing systems. Currently, 198 countries are the signatories of the treaty, including India. The panel said if it was not for the Montreal Protocol, the world would have been warmer by 0.5 to 1 degree Celsius by 2050. In 2016, the protocol was revised through the Kigali Amendment and it sought to reduce the use of hydrofluorocarbons or HFCs by 80 to 90% by 2050. HFCs have replaced CFCs in industrial use. It is further expected to prevent global warming by 0.3 to 0.5 degrees Celsius. According to experts, the success might be difficult to replicate in the case of greenhouse gases. The use of CFCs was limited to certain industries, and quicker replacements like HFCs were available in the market. On the other hand, overall economic activity is deeply linked with fossil fuels and greenhouse gases. It would take much more to reduce GHG emissions than a treaty, and it would require considerable lifestyle and behavioral changes.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Ultraviolet rays have the potential to damage DNA, and it can also lead to skin cancer. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.